Hi, I'm Terry Laxton. I'm the president of Providence Capital Partners. I'm an investment advisor representative, and I'm the author of a book called The Better Money Method, A Better Idea for Retirement. I wrote this book because about 20 years ago, my wife came to me and said, I think we need a 401k. I think we need a financial planner. Well, I told her I really didn't have a good feeling about either. But being an ex-school teacher, I knew I should do my research before I formed a final opinion. So I told her I would go do some research and get back to her. What I found in that process were two very disturbing things. Number one, the average 401k costs about 3.4% to own. I think it's actually 3.1 or 3.37, something like that, but approximately 3.4% to own. And on top of that, a vast majority of people put mutual funds inside their 401ks. That's all they're offered. Well, mutual funds also cost 3% to own. And according to Jack Bogle, the founder of Vanguard, mutual funds earn 45% of what the market does. So I thought about this for a second. Now I'm buying an investment that costs 3% and putting it inside a vehicle that costs 3%. Also, I can have a short-term tax deduction. And all my life, I've seen people take short-term actions to get tax deductions without thinking of the long-term consequences of it. So once I discovered that, I did the research. It took me quite a while. That's where I discovered the principles of the Better Money Method that I describe in my book. What I find is my clients are looking for several things. They're looking for a retirement plan that lets them sleep at night, one that they feel secure with. They're looking for a retirement plan where they can keep their money in spite of taxes and in spite of health care costs. They're looking for a retirement plan that will let them keep as much of their money as they can, again, in spite of taxes and the economy. And they're looking for plans that will conceivably leave money to their heirs if possible. So what are they telling me? What are they asking about? What are their concerns? They're concerned about taxes. They ask me, how high will taxes go in the future? Because this is going to determine how much of their money they can take out and use for themselves versus have to give to Uncle Sam. They worry about not having enough money to keep up with the cost of living. And they worry about health care costs, longevity. And the biggest concern they have is how do they get a reasonable rate of return? It seems that there's no safe way to get a reasonable rate of return now. They have no idea how to use the various plans they have. A lot of them have IRAs, 401ks, 403bs, SEPs, mutual funds, etc. They don't know how they all fit together. They don't know what will happen in their retirement, whether they'll work or not. And they don't know about taking Social Security. There's a lot of seminars now on Social Security, how you should take it. Certain things have been changed with the last tax law, but if you learn to take Social Security in a way that maximizes your retirement income, you can literally increase your retirement income by thousands of dollars per year. This is part of what we teach our clients. So this all boils down to 6 key threats to retirement planning. The first one is the effect of the high cost of low interest. You have probably noticed that over the last 15 years, interest rates have been artificially low. This creates problems in retirement. The second one is how inflation affects your retirement. We'll talk more about that later. The third one is improperly balancing risk in retirement. This is a huge problem for people. And the fourth one is outliving your money. Studies show over and over and over this is a huge concern to people going into retirement. And the fifth one is choosing how to take Social Security correctly. These are all threats to a secure retirement. These are all things the Better Money Method can address. And number 6 is choosing plans where taxes work against you. That's exactly what IRAs and 401ks do. As I said before, people take short-term tax benefits in exchange for long-term liability without giving it much thought at all. That's something we'll go through in more detail. Why do we do this? Well, here's a quote that I think sums it all up. When all people think alike, no one thinks very much. And that's exactly what you're doing with your IRA and your 401k. They came into existence in the late 70s, early 80s. And at that time, they started to replace pension plans. And so people get a job, they get out of college, they go to HR, they're told get a 401k, they'll get tax deductions and taxes will be lower in the future, and then they never give it much thought. This quote really sums up what's going on with retirement planning in this country. So let's do a case study on one of my clients now and show them how the Better Money Method works. Meet Doug and Barb. He's 60, she's 58. He's an executive, she's a school teacher. They have 3 grown children and 4 kids, grandkids, and they have about $1 million. And when they contacted me, they're like so many people I'm talking about. They have an IRA, they have a 401k, they have a 403b, they have a portfolio. They had certain goals and they weren't sure how all this fit together. And they've been happily married for 40 years. So here's what their concerns were. First of all, they wanted to retire in 2 years. I explained to them, this is a huge problem because baby boomers are the first generation in history to realistically look at spending 20, 25, 30 years in retirement. And retiring at 62 is a very young age. They said they understood that, but that's what they wanted to do. So that was one of their goals. They were concerned about what the cost of living would do, how increases in inflation would impact them going forward, and they were concerned about outliving their money. And Doug wanted to make sure Barb was taken care of if and when he passed away. And statistically, that's what's going to happen. The male is going to pass away first. Another thing we show with the Better Money Method, I specifically like to set things up to benefit the wife once the husband passes away. I think that's very, very important. And they wanted to have access to emergency funds. So here's what we did. They got a copy of my book and they read it. Then they were in New York, so we were doing all this over the phone. After we talked briefly on the phone for about 15 or 20 minutes, he sent me all of his financial information. The balances in his IRAs, his 401ks, and so forth. Barb had a small pension, which helped, what their Social Security income was at certain ages. I took that and went through and put together a budget. We determined they wanted about $75,000 a year to live on in retirement. A very lofty goal when you've only got $1 million. And we reviewed their planning options and put them into something called an IUL, which is described in my book in great detail and will be described in one of your downloads on a future video. In the process, they asked me about the difference between their current plan and the Better Money Method. So I showed them this chart. Under their current plan, they were subject to market losses at any time. With the BMM, which is what I call the Better Money Method, no. Subject to taxes, yes. With the BMM, no. Subject to RMDs, which we'll talk a little bit more about later, yes. With the Better Money Method, no. Subject to a low rate of return. As I just talked about, interest rates have been very low for the last few years. Yes, in their current plan, in fact, he had a lot of money. His portfolio in money market funds have paid virtually nothing at this point in time. Not so with the Better Money Method. Income on Social Security is taxed. People don't understand how Social Security is taxed. In their current plan, they were going to have massive taxes on their Social Security. In the Better Money Method, no. So after I showed them this, let's talk about our process. The first thing I ask people to do is read my book, The Better Money Method. The second thing I ask them to do is gather together all of their account information and determine what the taxes are in their state. As I said, I deal with people all over the country, and taxes vary depending on where you are. The third thing I ask people to do is put together their ideal retirement budget. What would they like to accomplish? Now, I can't always accomplish what people want. I tell people, if you've only got 2 lemons, I can only make so much lemonade. But I can always improve their position with the Better Money Method. And the last thing we did was we determined the shortfalls in their retirement income and how to cover those gaps through the Better Money Method. So the first thing I want to talk to you about on these threats is the high cost of low interest. This is a double-edged sword. Here's what interest rates have done since 1985. They've been high and they've gone low. In fact, recently I saw a bank running an ad saying, we have CDs at 1%. Right now in Japan, if you put your money in the bank, you get a negative rate of return. This is great if you're buying a house or buying a car. It's awful if you're trying to get retirement income. I talked to a lady not too long ago that had always been able to live off the interest on her money. Now she said they're having to live off the principal, and that's very disturbing to her. And it should be. Back in the day, as they say, if you had a fair amount of money, you could go to a bank and get a CD for 3.5%, 4%, 5%. That time it was pretty easy to plan for retirement, but not anymore. The other thing people don't realize is what it takes to recover from market losses. During the 2000s, we had 2 major stock market crashes. And when you understand this, if the market goes down 5%, you have to gain 5%. But if the market goes down 10%, you have to gain 11.1. If the market goes down 15, now you have to gain almost 18 to break even. If the market goes down 20%, you have to gain 25%. If the market goes down 25%, now you have to gain 30%. People will look at this and say to me, that doesn't make sense, or that's not intuitive. Well, here's what I tell them. If you had $100 and you lost 25%, now you have $75, right? You need to gain back $25 to break even. $25 is 1/3 of $75. So you really do need to make 33% to make up for a 25% loss. And if the market goes down 50%, which it did in 2008, it went down 40+%, you have to have 100% gain to break even. This is why people have so much trouble getting ahead in the marketplace. This is why, if you started in 2000, after all the ups and downs of the 2000s, you ended up between 2000 and 2015 making less than 2%. But people don't realize that. They think the market's back, except now everybody's paranoid about the market, so they're happy. But this is a huge detriment to retirement planning. This led the Wall Street Journal to put this headline out: say goodbye to the 4% rule. The 4% rule is something that used to be the staple with financial planners, and a lot of financial planners still use it. What it says is, if you have a portfolio, if you have a 401k, if you have any pile of cash, you can expect to pull out 4% a year, adjust it for inflation, and not run out of money. This headline said that rule is dead. That's what's going on with interest rates. Now let's talk about the impact of inflation. And the way I like to show this to people, I take this shiny $100 bill I just printed, and I show them, if I put this in my 401k in 2000, and after all the ups and downs of that decade, in 2015, I can take out $101.80, less than $1.90 was my cumulative gain over that 16-year period of time. But here's the problem. Is this $100 I get out in 2015 the same $100 I put in 2000? Most people say no. Why? Because of inflation. Correct. Over that period of time, inflation consumed 50% of your buying power. So you put $100 in your 401k in 2000. You get back $50 of buying power in 2015. But that's not all. Uncle Sam gets his share. And does Uncle Sam say, I realize that's only $50, pay me on the $50, or does he say, I want my share of the 100? That's right, he wants his share of the 100. So you had 50% go to inflation, 25% go to Uncle Sam. So the net result is you put $100 in your 401k in 2000, you retire in 2015, and you have $25 worth of net buying power for every $100 you put in. That's a huge problem for people in retirement. So here's the thing you should do today. Click on the link below to download a white paper that I call Taking the Risk Out of Retirement, which is Cliff Notes of my book. In the next video, we'll go over the myths of retirement planning. Then we'll show you how to overcome the two main challenges to retirement income: market loss and taxes.